Welcome to the deep dive. We're jumping straight into some pretty interesting news out of Disney.
Yeah, their latest financial update just dropped, right?
Right.
From yesterday, May 7th.
Exactly. The Motley Fool covered it.
Yeah.
We're going to look at their performance numbers and also this surprise announcement about a new resort.
Right. The goal is to understand, what's behind this beat and raise they're talking about.
And what this new park in Abu Dhabi really means for them strategically.
It's definitely more than just numbers. It's about strategy, where they're placing their bets.
So let's start with the finances. The results were better than expected, yeah.
That's the headline. Analysts had penciled in about, $23.1 billion in revenue?
For Q1 of the calendar year, which is Disney's fiscal Q2, that would have been about a 5% increase.
And earnings. Adjusted earnings, they were expecting those to be pretty flat, right? Around $1.21 or so.
Yeah, that was the consensus. Adjusted earnings, just to clarify for everyone, that's sort of the core performance figure, stripping out some unusual items.
But what Disney actually delivered was quite a bit stronger.
It really was. Revenue came in at $23.6 billion. So that's a 7% increase, a bit higher than predicted.
But the earnings story is where it gets really interesting.
Definitely. Adjusted earnings hit $1.45 per share.
Wow, okay.
Yeah, that's a 20% surge compared to last year. Not flat at all.
So much for flat. What drove that big jump?
Well, the report mentioned a 15% jump in segment operating income playing a big role. So this is the classic beat and raise situation we mentioned.
They beat the estimates for the quarter.
And then they raised their forecast for the whole year, which is, always a good sign for investors.
Absolutely. That kind of beat really makes people sit up and take notice. And the article puts this in context, too, comparing it to Comcast's theme parks.
Right. That's a useful comparison. Comcast actually saw their theme park revenue drop by 5% in the same period.
And their EBITDA, which is a key profit measure, that plunged 32%. Ouch.
Yeah, a big drop. So when you look at that,
Disney's park performance looks even better.
Exactly. Their domestic parks and experiences division, revenue up 9% and operating income up 13%.
That really shows the strength and maybe the resilience of the Disney brand in the park space, doesn't it? Even with, whatever economic pressures are out there.
Seems like it. And it wasn't just the parks shining.
No, the streaming side too, right? Direct to consumer.
Yeah, Disney Plus and the others. They're really turning the corner on profitability, it sounds like. Operating profit there soared, get this, sevenfold compared to the same time last year.
Sevenfold. That's massive.
Yeah.
That suggests maybe they've cracked the code on costs or subscriber value.
Could be a mix of things. Better content resonating, maybe higher prices sticking, lower costs to get subscribers. It's finally adding up on the bottom line.
Of course, the flip side is the legacy TV networks.
Right, linear TV. The article mentions that's still fading, which isn't a huge surprise.
No, that's the industry trend. But the key thing is the combined business streaming and linear is still growing overall.
So they're managing that transition, it seems. Strong quarter.
Very strong. Which leads directly into the next point. The increased guidance for the full year.
Ah, yes, the raise part of the beat and raise. What was the old forecast?
Previously, they were guiding for just single-digit growth in adjusted earnings for this fiscal year, fiscal 2025.
Okay, single digits. And then they expected it to pick up to double digits in the following 2 years.
Right, that was the plan. But things have apparently accelerated.
So what's the new guidance look like?
Much better. Now they expect adjusted earnings for the whole of fiscal 2025, which ends this September. Remember to hit $5.75 per share.
Okay, $5.75. How does that compare to last year?
That's a 16% increase over fiscal 2024.
16%. So wait, they're hitting double-digit growth this year.
Exactly. A full year earlier than they previously signaled.
That's a significant shift. Shows a lot of confidence.
It really does. And it's also higher than what Wall Street was expecting. Analysts were thinking maybe $5.44 a share for the year.
So they beat their own guidance and the market's expectations.
Yep. And the article clearly links this boost back to the strengths we just saw in this latest quarter's results.
Makes sense. That strong performance gives them the foundation to raise the bar for the rest of the year. Okay, so finance is looking up. But then there's this other piece of news.
The Abu Dhabi resort.
Yeah.
Yeah, that kind of came out of left field, didn't it?
It did seem a bit unexpected. This will be their 7th Disney-branded resort globally. Location, Yas Island in Abu Dhabi.
And the really interesting part here, I think, is the business model.
Totally agree. It's not the usual way Disney does theme parks, is it?
Not usually, no. It's modeled after the Tokyo Disney Resort arrangement.
Which means?
Which means Disney won't actually own it. They won't have an ownership stake. And crucially, They're not putting up the capital investment.
Huh. So if they're not owning it or funding it, what's their role?
Their role is primarily in the design and development. They bring the Disney magic, the IP, the know-how.
Okay, they provide the creative blueprint. And what's in it for Disney financially then?
Royalties. Ongoing royalty payments based on the resort's performance.
Ah, so it's a licensing deal, essentially. That sounds quite low risk for Disney.
Extremely low risk from a capital perspective. They get to expand their brand footprint, tap into a wealthy market, and generate revenue without having to build and operate the whole thing themselves.
Smart. And the article mentioned Bob Iger, the CEO, brought up something related during the earnings call.
Yeah, he talked about their new cruise ship venture based in Singapore. Apparently, it's sold out really quickly.
Okay, so the point being...
There's huge pent-up demand for Disney experiences in new international markets like Southeast Asia and, by extension, the Middle East.
Got it. So this new Abu Dhabi park isn't likely to, say, steal visitors from Orlando or Paris.
That seems to be the thinking. It taps into a different regional market, expands the overall pie rather than just slicing it differently. It's about global reach.
Okay, so we have strong financials, boosted guidance, and this new kind of clever, low-risk expansion project. How did the market take all this? Investors must have been pleased.
Well, you have to remember the context. Disney stock hadn't been doing great before this.
Right, the article said it was down 19% since the last financial update. Oof.
Yeah, it was underperforming the market. There was definitely some, let's say, bearish sentiment around the stock.
So did this news change things?
It certainly seems like it did. The combination of the earnings beat, the raised guidance, and the Abu Dhabi news. It triggered a nice surge in the stock price.
Back above $100.
Back above $100 a share on Wednesday morning, according to the article.
So maybe this marks a bit of a turning point, reversing that negative narrative.
It definitely has that potential. It feels like a dose of good news and smart strategy that the market was maybe waiting for. It could help rebuild some of that lost investor confidence.
Okay, let's try and wrap this up then. Key takeaways. Disney had a really strong quarter financially.
Beat expectations, raise the outlook for the full year. That beat and raise is crucial.
Super important signal after that period of stock underperformance. Gives investors something concrete.
And then there's the Abu Dhabi announcement. A new resort, but done differently.
Right, that royalty-based model. Seems like a savvy way to grow internationally without tying up billions in capital.
Yeah, leveraging the brand, managing risk, feels like a smart strategic play.
Okay, so here's something to maybe leave you thinking about. If this royalty model in Abu Dhabi works out, what does that tell us about Disney's future global plans?
Right. Is this a template? Could we see more Disney-branded but not Disney-owned experiences popping up in other regions?
Yeah, where else might this kind of partnership make sense? Latin America, India, Africa. It definitely opens up possibilities beyond just building another massive park themselves.
It suggests a potentially more flexible, capital-light approach to international expansion, something to watch for sure.